We have Don Straszheim joining us today. He is, well, basically he works for the ISI Group. He's the Senior Managing Director of China Research. And previously we have Don serving as Chief Economist at Merrill Lynch in New York. And I'm looking at the stats here. You were voted to the Institutional Investors All-Star team for 10 consecutive years.
Long time.
That's a nice run there, Don. Thank you for coming and joining us here in the Hong Kong studio. You know, let's parlay this into talking about the mainland market, because we're talking about what Hong Kong is doing to try to rein in property prices at this point. From what you're seeing on the mainland, you know, people are talking about bubbles in the property sector and also more tightening. What do you think is taking place?
Well, there is clearly a high-end bubble, excuse me, in some of the biggest cities, excuse me, in China, but not in the second and third tier cities. They've imposed a variety of measures in April. You just announced, talking about more of that coming here. I think China will continue to do more of that as well, and it'll start to slow prices.
Right, and you're saying that there's a great chance that the economy gets too cold rather than too hot right now, because the Chinese government has done enough in your view.
I think so. The economy was growing 12% or thereabouts at the beginning of the year. It's down to 7 or 8 now. I think that's an appropriate level for China's economy at this point. But the slowdown has been really quite rapid in the last several months. And the risk is that it gets too cold, I think, rather than stays too hot. And if it does get too cold, China will act, and they have the flexibility to do so.
Yeah, you know, you were talking about property prices, and you said we have a high-end bubble in your view, at least in the high-end, I guess, property segment. What about the stress test that, I guess, wanted to put in an expectation of a 60% drop in property prices? Some people say it's realistic. Some people are saying it probably won't even happen.
No way. There were about 60% price gains on Hainan Island, but there's no other city in China that shows anything like those kind of price increases. And if they were to go down 60% from now, that would leave them about 40% below where they were in 2005, versus incomes up about 80%. That is just simply not realistic.
That's really not realistic right now. Recently, we had a report coming out that said that, you know, it seems like China's a cash-based economy. So a lot of people are actually keeping more of their cash underneath their mattresses that isn't actually spilled out into the real economy. So maybe China has more cash at hand and has more support than what's initially thought. So the economy is doing okay.
Well, the 12 or 14% price increases in housing has a lot of people worried. But incomes have been rising over 10% a year now for 25 years. And there's 500 million people in China who have enjoyed an 8 or 10% a year per capita income growth for a quarter century. They want to spend that money, and housing is one of the ways they want to do so.
Yeah, and we also got a report, because don't forget, China's already cashed up with those massive currency reserves, right? 2.4 trillion, I believe, the biggest in the world. But we got a report today saying that China prefers buying euros right now over the U.S. dollar. I mean, the euro hasn't been performing that well for this year, and there obviously is a lot of, you know, debt crisis concerns in that part of the world.
Yeah, I think these stories are a little bit premature. Over the last decade or so, China has rarely bought one currency and sold another. Rather, they have simply allowed their foreign exchange reserves accumulate as a result of their trade balance by currency and their foreign direct investment inflows minus outflows by currency. And to break that natural result and buy one currency and sell another is a very risky proposition for the State Administration of Foreign Exchange, and I don't think they will do it.
And what about them buying these JGBs recently, these Japan government bonds? Again, people are looking at China trying to diversify and getting into the stronger yen.
Well, I guess I would go back to the broader proposition that if you make a bet on one currency versus another, it may look good in the short run. But in the long run, I think China will continue to prefer the policy to allow their foreign exchange reserves to accumulate as a result of the natural forces, which is not trading, but it is their trade surplus or deficit and the foreign direct investment surplus or deficit.
What did you think of those figures last week? You know, on the trade numbers, being with the trade balance, again, we're seeing it, you know, lengthen, strengthen, I guess, in some ways. What do you think about the state of the Chinese economy? Because we've got a lot of numbers coming out. We had inflation numbers higher than expected, 3.3%, but a widening trade gap as well.
Well, I don't think the inflation problem is really a problem 3.3% in July. Was up a little bit, but we're going to see it in the 3 to 3.5% range. That's very close to what Beijing officialdom regards as acceptable. The economy has slowed. There is a big trade surplus, primarily because the foreign countries to which China wants to export are weak: Japan, Europe, and America.
Oh.